Chapter 14 is corporate non-liquidating and liquidating distributions. Good times. All right, so obviously we're talking about, in talking about distributions, we're talking about getting basically money from, most of the time money, sometimes assets, from the corporation to the shareholders. Okay, since whatever the corporation shells out as a dividend, anything that's called a dividend or considered a dividend falls into the category of double taxation. So, because it's going to be taxed at the individual level when you distribute it out to the shareholders. So, obviously, dividends are taxed as income to the corporation and taxed as capital gains to the or dividend income to the individuals. There's also that 3.8%. I think we looked at a couple of examples in the past where we had to include that because of the high adjusted gross income of the people in question. Now, there's also the option of essentially getting back some of our basis, or in other words, receiving back money that we are considering having been contributed to the corporation. So this would be like, hey, I'm investing $5 million in company A by purchasing stock, and then I get $1 million back this year, but my basis is now only $4 million. That would be, obviously, you can see why we're not going to want to tax that money, because we're just considering that getting our money back. So that basically occurs, most of the time that will occur if money's flowing back out to the shareholders when there isn't any earnings and profit, which is more or less net income, but there's a little bit more to it than that. But to the extent that there is earnings and profit to distribute as dividends, then there will be dividends. But if money is distributed as if it were a dividend, even though we don't have earnings and profits to distribute, then it would fall into that category. Once we get down to having a basis of 0, then instead of return of capital, it becomes a capital gain to us. So this is just kind of another way of looking at those three options. So like we said, any money that is going out that's not a salary, I guess we should say that, assuming our shareholders are working for the company, they could also be earning a salary. But if we're putting money out to them, distributing it to them, it's not a salary. They're not debtors. They're not. There's no other claim they have on our money, and we're putting money out there. As long as there's current or accumulated earnings and profits, then it will be a dividend. If there's not, then we start zeroing out their basis to the point where, obviously, anything past 0 would have us just recognizing capital gains. So we will track our earnings and profits, which again I said is basically net income plus adding some items back in, essentially. And anything that we don't distribute out this year from our current earnings and profits basically would roll into the accumulated earnings and profits. And this is not necessarily an account that we're keeping, just track that we're keeping of these items, because like we said, this is not the net income that we would track in financial accounting. So we're definitely tracking these numbers, but they're not necessarily on the books anywhere. So when we're trying to calculate earnings and profits, we start with taxable income, and then we're basically going to make some adjustments to that based on these 4 categories. I actually don't get a whole lot out of this slide, but I left it in here just in case it does something for you guys. These are the order that you would distribute in earnings and profits given these following 4 situations. And there are some times when it matters. Well, I should say it matters that we track these accumulated versus current. But this particular slide does not do a great job of explaining that, I don't think. Some of these examples might be better, though. So in this one, example 1, positive current, negative accumulated. So we distribute $1 million on July 1st. Is that all considered out of current, or do we net these 2 together is basically what this is getting at. And we will go first all of current. So we can use all $1 million of the current earnings and profits to distribute out as a dividend. This would be one of the reasons why it's important to track accumulated versus current separately, because even though we have tallied a negative balance in our accumulated account, we did this current year have $1 million of earnings and profits. And so basically before we even look at this year's effect on accumulated, we can go ahead and distribute that whole thing out as a dividend. So this is a slightly different scenario here, but in this one, we've got a negative balance for this year. We've got and this is as of the end of the year. Okay, so I guess that would be important for this scenario. This is from previous years built up. And midway through the year, we had a distribution of $1 million. Well, you would maybe look at this without looking at the date and say, well, negative $1 million here, so definitely this full $1 million is going to be considered not a dividend because these 2 would just would net out. However, we're showing you here that since it's July 1st, we're going to prorate this loss or this negative amount for the current year, and then when we net these 2 out, that would give us $500,000 earnings and profits to distribute as a dividend, and then the rest would be return of basis. You can just read that slide. I don't have anything to add to that. So it's just letting us know that if we pay out non-cash property as a dividend, and assuming that that basis is different than the fair market value of the item that we're paying out, if we should be recognizing a gain on that property, so in other words, tax basis is less than the fair market value of the item, then we're going to have to recognize that. But if there's a liability attached to the property and the liability combined with value outweighs the liability, in other words, that would give you a overall value being negative. So essentially, if I owned a house that was worth $100,000 and it had a $200,000 mortgage on it, and I said, here, I'll give you my house, but you got to take the mortgage with it. Of course, you wouldn't do that because you would be taking on a liability that was greater than the value of the house. Well, that's the same thing. IRS is basically saying, hey, if that scenario comes up, we know no one in their right mind is going to agree to that unless there's something that we don't know about going on. And so if that's the case, we're gonna treat it like it's a wash. So that's why, I guess, the long and short of why you would not ever recognize a loss on something like that. So this is just an application of that principle. You can take a look at the example there. We've talked about this a little bit before, but essentially the corporation has a lot of incentive, especially if the shareholders are also working for the corporation, has a lot of incentive to pay out money to shareholders in a way that is not considered a dividend, because anything that's considered a dividend is going to be taxed twice. So anytime that basically the IRS is going to have going to be paying close attention to what it may view as unreasonable compensation. So we're trying to hide a dividend by raising salaries. If we are selling things to shareholders for less than their value, basically any way that we're trying to give value to shareholders without recognizing that in its proper course as a dividend. If that occurs, obviously the IRS is going to ignore the form of what you're doing and look at actually what's going on behind the scenes and just imply that that is going to be a dividend. When we talk about putting out extra stock to the shareholders, as long as these two, instead of paying them in dollars or in property, other kinds of property, as long as these two requirements are met, then the stock distribution is not a taxable event. The reason behind that is basically that if those two qualifications are met, basically the stockholders are essentially unchanged in that scenario. In that case, then you would use this calculation to figure what your adjusted basis in the new stock is. Now, non-pro rata stock distributions are usually considered dividends, and this is basically where there are stock distributions going out that have some other stipulation on them other than just, okay, we're going to double everyone's stock. Or if there's anything, if it's tied to anything other than what your percentage is in the stock already, and if after the stock distribution everybody doesn't own the exact same percentage of the company that they did before the distribution, then it would be a taxable event. I'm not going to spend too much time talking about stock redemptions. You can take a look at these slides, and I just don't want to muddy the water too much on these, but take a look at the slides and materials on stock redemptions, and ask me any questions that you might have regarding how those work. I tend to get a little verbose talking about them, and usually end up just confusing people. So I'll leave it as basic as I can, let you take a look at these slides coupled with the materials that you're reading about stock redemptions, and like I said, just let me know if you have any specific questions about them. All right, so we'll pick up again talking about partial liquidations. Let me just, oh yeah, we'll pick up there. Okay. Now, when a company has a partial liquidation, they're obviously not going completely out of business. They're just basically shrinking, or at least shrinking ownership. So they're going to get rid of some of their assets, and they're going to distribute those out to shareholders in exchange for shareholder stock. Let me go back to that. Sorry. So this can be accomplished by distributing stock of a subsidiary. If a corporation owns stock in another company, it could be if the company has a number of business components or a number of different businesses under its umbrella, you could sell off one of those and distribute the proceeds to shareholders in exchange for stock. If the corporation is doing it on a pro rata basis, in other words, again, without respect to anything other than your ownership percentage in the stock, and everyone gets the same amount deducted, then it's treated the same way when we're talking about stock distributions, and the same rules apply that would apply to stock redemptions. Obviously, that would be contrasted with complete liquidation of a corporation. When a corporation completely liquidates, this would again create a partial year tax year. Form 966 would be filed, and that would need to be filed within 30 days after the owners make the decision to liquidate the corporation. Obviously, we've talked about total liquidation before, but that's basically would follow the same rules as each year-by-year distribution to shareholders, where you would look at earnings and profits, distribute those as dividends. Once you're out of that, distribute everyone's basis in their stock back to them. If you can get back to zero on all shareholders at that point, then anything that's left over would go out as capital gains to the shareholders. It's just kind of another way of looking at what I just said. There are certain cases where in liquidating, their losses are not allowed. So related parties, if you're distributing out property to related parties, we're not going to allow a loss on that. And any pre-contribution loss, depending on the class of the property, basically boils down to looking at whether there was a tax avoidance motive. Not going to spend too much time on 351 transactions, just a little bit beyond the scope of an intro tax class. Take a look at a couple of these examples though. So we got Cedar Hill has two shareholders who are unrelated to each other. Cedar Smith, 80 shares, Kevin Hill, 20 shares. Cedar Hill adopted complete liquidation plan January 1st of year 1, held the following assets with no liabilities on the date of liquidation. So you can see we've got some cash, which obviously equals its fair market value. We've got some property that has gone up in value, and we've got some property that has gone down in value. How much amount? will Cedar Hill recognize on the distribution of the lost property? The entire $80,000 amount. But why? So in this case, we're saying, hey, yeah, we know that the corporation distributed to the shareholders, who are obviously related parties here. Well, at least this particular one, let's see, was, oh yeah, so tenants in common. So basically we're saying at least one of these, the 80% shareholder, is potentially a related party, because this we're saying that shareholder owns 80% of this property, and so that, or I'm sorry, that shareholder owns 80% of the corporation, or owned, and when this distribution occurred. However, there's no indication that this property is disqualified property. If it was, we would look at it a little bit differently, but since the facts are silent there, we can allow the whole thing. So same effects as example 1, lost property. So we are saying this is a Section 351 transaction, even though I say we won't spend a lot of time on that. But just assume, other than looking at what that means, just assume that this is a 351 transaction. So on November 1st, year 1, CH sold lost property to unrelated party for $200,000. December 31st, CH completely liquidated and distributed gained property in cash to Cedar and cash to Kevin. How much loss does CH recognize on the sale of lost property to the unrelated third party? Well, we would determine that this is a 351 transaction, but this is the to a non-related party. In this case, though, the reason that we're not allowed to deduct the whole thing is because of we're only allowed to deduct the amount of loss that occurred after the property was contributed. So pre-contribution loss is disallowed in this case. So whenever a corporate shareholder or a corporation that owns stock in another corporation owns at least 80% of that other corporation's stock, and that other corporation happens to be the liquidating corporation that we're talking about, then the corporate shareholder, the one that's still alive basically, recognizes no gain or loss on the liquidation, and any assets that come over, so anything that's not cash basically, will keep whatever basis they had in the liquidating corporation's hands. This should be fairly self-explanatory, because that greater than 80% amount is basically telling us we're assuming that we essentially own all of the underlying corporation. So if we own it already, so it doesn't really change hands going from that corporation to the other corporation. And the IRS is pretty much only interested well, they're interested in money, but they have made it their policy to only tax transactions that occur when for the most part, when they're changing hands, when an asset is changing hands. So that would be the reasoning there. Now, assuming that there are minority interest shareholders, so you own, Corporation A owns 85% of Corporation B is liquidating, and 15% is owned elsewhere, then that minority interest shareholder follows the same rules as a fully taxable liquidation. The liquidating corporation itself doesn't recognize anything to do with anything that it puts out to the other corporation, the corporation that owns most of the liquidating corporation, but any assets that are non-money assets that go out to the minority shareholder in that case would any gain associated with those would be recognized, and again, any loss associated with those, again, we would not recognize the loss. The reason would be because the IRS implies or assumes that no one is going to accept as payment or as a distribution a piece of property that to accept it you would have to take over a liability that is worth more than that asset. It just doesn't make sense. So our final example here, we got a liquidation of a subsidiary with a minority interest. Colonial Corp has two shareholders. Creekside Corp owns 90%. Dave owns 10%. Colonial has several gain assets and several loss assets. Colonial adopted a plan of complete liquidation on January 1st of year one. On December 31st of year one, Colonial completely liquidated by distributing its assets pro rata to Creekside and Dave, so each according to their percentage ownership. A percentage of each, so basically 90% of each asset is going to Creekside, 10% to Dave. What gain or loss will Colonial recognize on liquidating distributions? So this becomes a bit of a strategic matter because in the eyes of Colonial, they're not going to be able to deduct any loss on the loss assets, no matter who they're distributed to. So distributing the loss assets to a minority shareholder might not make sense here, especially if the actual controller of deciding who gets what in the distributions is the corporation, Creekside Corp. If Creekside Corp is the one who's deciding who gets what, then they should distribute out the loss assets to themselves so that the loss is something that they could take advantage of at a later point. Otherwise, if they distribute it out to Dave, then that, at least with respect to the benefit that it could have for Colonial or Creekside, that essentially goes away with that distribution. All right, so that's pretty much all I have for this chapter. I know there are some nuances, maybe slightly confusing. So as you're going through the materials, if you have a question, reach out, let me know, and we'll go from there.